Today, the false Armageddon. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest posts covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by our economist, John Adams. Hello, John.
How are you going today?
I'm very good. How are you?
Excellent.
So we're going to have a little look at what Armageddon really might look like.
Yes. There was a couple of interesting articles today, one on news.com with some comments from our new Prime Minister, Scott Morrison, about house prices. And then obviously there was a article on the ABC this morning about the perfect financial storm. And obviously we're seeing a narrative in the media about the crunch coming. But the crunch that I've been talking about when I've been writing these articles, particularly for News Limited, about economic Armageddon, what we're seeing in the media at the moment and what the commentary is not what I'm actually warning about. And I thought it'd be worthwhile to cover what has been sort of expressed in the press today, and obviously cover your definition of Armageddon, my definition of Armageddon, and then obviously talk about a prominent American economist who came out in the last week and said that there's no strategy among global policymakers to deal with the Armageddon that I'm warning about.
Right. Is your Armageddon bigger than my Armageddon?
It is actually. It is. You know. So if Koukoulas went crazy over 45% house prices, my definition of Armageddon, if we do have a depression, based on historical experience, you look at Japan, you look at what happened in the early 80s in the US, house prices in a truly apocalyptic scenario, we're talking 80%. We're not talking 40-45.
Okay. A mere 80% drop in house price values. Okay. Well, that's enough to wake people up.
Indeed.
Okay. So let's start with the articles then. So there was a couple of really interesting ones that came out today.
Indeed. So there was one article. Scott Morrison gave a interview with News.com and talked about the coalition's policies related to housing and taxation versus Labor. And Morrison had a very provocative set of words, if I could put it that way, which was that if Labor introduced their policies on negative gearing and capital gains tax changes, Morrison said this could, quote, invite a housing market crash. And obviously that quote was the lead in the news.com story. So the interesting thing with that one was that there was a particular quote that Morrison gave in the interview that really sort of caught my attention. And the quote was, this is Morrison, everyone has recognized that one of the biggest economic risks that the country faced was a housing market crash. That's what the rating agencies were concerned about. That's what the banks were concerned about. That's what economists all around the country were concerned about. That's what, as Treasurer, I was very concerned about. So we needed to bring the housing market into a soft landing. So I find this very interesting because we know that back in November of 2016, Morrison was talking about the housing market, talking about these taxation policies, and he basically said there was no bubble. And he basically said that house prices were effectively determined by fundamental factors, and there was no evidence that that house prices went above what the key determining fundamental factors were.
There is no doubt that the availability of credit has made it easy to invest in residential property post the GFC. But to imply that a credit-fueled, investor-speculated housing bubble is the main driver of house prices is an overly simplistic conclusion. For this to be true, house prices need to have moved by more than some conception of fundamental value. It is only in this case where the overall market is at risk of a severe correction. This is one of the key differences between what is happening in Australia and what has happened in other countries that have experienced difficulties in their housing markets. The increase in Australian housing prices, as I've said, has been largely driven by fundamental determinants. It has also not been accompanied by the more lax regulation and lending standards witnessed in other countries. Australia had a comparable run-up in dwelling prices to the US in the early 2000s, but there were some key differences. In Australia, our banks applied stricter lending standards than their American counterparts, with fewer low doc or subprime loans. Further, unlike in many parts of the US, our lending is based on full recourse financing, so the borrowers just can't walk away from their loans and throw their keys in the door and walk away. That's not how our market operates, and that has a fundamental impact on the strength of our markets.
He did say that lending standards were robust, and that APRA was doing a great job, and the banks had sort of sound practices and obviously sound lending standards. Now, this was obviously pre-Royal Commission, and obviously either Morrison didn't know or he didn't want to say at the time, but obviously the Royal Commission has exposed that underlying premise to be completely false. So basically he basically said then house prices were determined on fundamental factors. There was no evidence of investors fueling a housing price bubble. Now he is saying today that there was concern all around the place, the rating agencies, the banks, he was concerned, and that they have taken action to reduce house prices, but they've done it using a soft landing, and that this soft landing, what we're seeing now, which you've been talking about in several posts, particularly in the Sydney and Melbourne market, that soft landing has achieved the policy goal in terms of what the great risk was. Now, we've said in previous episodes, in my view, the risk is not house prices, the risk is household debt, and the debt continues to go up. So I think, if this is where the Prime Minister's thinking is, he's completely focused on the wrong problem in terms of house prices, number one. And number two, I think that the risks to the economy haven't been alleviated at all. I think they are continuing to rise.
Well, just remember that credit is still growing at 5.5% on an annualised basis, according to the RBA, for housing.
Yep.
Still growing.
Yes.
Right? And unoccupied housing credit is growing at more than 7%.
Indeed.
Which is weird. I mean, you'd almost say, why on earth is it doing it? And there's a few reasons for that, which we can perhaps look at another day. Okay. Now, the other point that was in another article was talking about the housing sector and the property market and the economy generally, right?
Yes. So the ABC was talking about there's a brewing perfect financial storm, and they basically said there's a combination of factors playing among the owner-occupier market. So we're seeing house prices fall. We're seeing people getting into sort of potentially negative equity sort of situations, but we're also seeing the conversion the emerging conversion over the next 12 to 18 months, particularly of interest only to principal interest loans. This is going to have a huge impact on in terms of cash flows for in terms of households and the ability to service their loans. Now, I think there's a different range of views as to when these factors come to play, how big will the impact be? I think the Reserve Bank in a speech earlier this year said obviously some people on interest only will be able to continue on interest only. A big chunk will have to convert to principal and interest. There are some who won't be able to meet those repayments, but I think the RBA said that fraction would be relatively small, and that most people would be able to absorb that higher cash flow hit. Now, we know from political polling that cost of living is the number one economic issue. For a lot of households, the switch from interest only to P&I think will be a big hit. But I don't think that this is, when they say this is the perfect storm. So this, in my view, is not going to lead to any systemic, crash of the economy. So I think in certain pockets people will get into some sort of trouble, but I think largely, and again we'll have to see how the economy plays out. I don't think this, I think largely the economy will be able to handle sort of these adjustments of a mild fall in house prices as we're seeing at the moment, but also these conversion of loans. So I think the media at the moment is talking about a couple of immediate factors that are playing, but the real Armageddon that I think potentially could be coming is much more significant than what we're seeing being reported in the press today.
So let's just talk about that a little bit longer, and then we'll get to your big mega Armageddon, the real McCoy, as it were. So there's 1 million households in mortgage stress, according to my research, right? And that's been growing consistently over the last few months, and it's because of flat incomes, rising cost of living, and now the mortgage interest rates rising a little, right? And if you overlay then the impact of the interest only, there's about 120 billion each year for the next 3 or 4 years that's going to come up for renewal. About half of those, from my analysis, will be fine. They'll be able to reset to, interest-only loans. But of course, that's going to take up the bank's capacity to lend to interest-only borrowers, right? Because they effectively will be new loans. A quarter of the remaining will be actually shifted to principal and interest. And it's interesting that a lot of those are actually being held by more affluent households.
Yep.
So quite a lot of the adjustment will be in the more affluent end of the market, which is where, by the way, we're seeing a lot of stress rising at the moment. And there's about a quarter left. And that's that quarter that I'm looking at very closely, because those are the people that will have to make some hard decisions about, do they sell, do they not sell? If they do sell, when do they sell? Because they don't have the ability to be able to meet the new lending standards for principal and interest repayments.
And I'm assuming for that cohort, if they attempt to refinance, they'll be knocked back on refinance.
Correct. So that they're no longer in bounds based on the current underwriting standards.
Yeah.
So unless the government decides to reverse track on the tighter lending standards, which I still think there's a chance they could do that, just to try and keep the bubble going a bit longer. But if they don't do that, then effectively we've got these people who are somewhat exposed. Now, I think there's a bigger cohort there than the Reserve Bank is recognising at the moment. I think it's quite a concentrated cohort at the sort of top end of the market. Quite a few of these people have not just one interest-only loan, but they have 2 or 3 or 4 or 5 because they've got multiple properties and they're all geared off each other. And that's where the pressure is. But I agree with you that the interest-only loan thing on its own is not going to be sufficient to tip the whole economy over. But I do think there is an impact, a second-order impact, in people's ability to spend at the shops, for example. So the economic impact is quite important, because they're going to hunker down, they're going to spend less at the shops because they've got less cash flow.
Yeah.
So I see that, but it is not, the start of the end, as it were, right?
Yeah.
So I agree with you in terms of relativity. It's there, but it's not necessarily the critical, massive hole that we're all going to fall into.
Yes.
Your hole is huge, and we should explain a little bit about how this plays out, because, of course, your Armageddon is looking much more systemically.
Indeed,
right?
Indeed.
And
but I was
over a longer period.
It is. But I was just going to ask you one question. In terms of the cohort that could get into trouble, so if there's a big chunk of these loans coming due in 2019, if the election is in April, May, which obviously I think Morrison's already ruled out a 2018 election, no matter what happens in the Wentworth by-election, do you think that a number of these sort of interest-only loan cohort could actually be a big factor before the election, or do you think it'll be sort of in sort of mid to late 2019 after the election?
Well, I know roughly, because I know the month the loan was taken out originally.
Okay, yeah.
So I can map that through as to when the 5-year checkpoint is, right? And it's pretty much distributed through the year. So there's a little bit of weakness around the start of the year because people don't do much over Christmas, New Year. But effectively from February, March, April, May, there are people who are coming up for renewal. So, I still have a feeling that we might see some little loosening of the tiller, as it were, to allow people a little more flexibility and latitude. And a couple of the banks have actually said that already, that they'll actually look a little bit differently at some of these loans and perhaps help people through. So they may move it across the other side of the election, possibly.
Yes. Look, it'll be. I think it's a very interesting point to watch to see if underwriting standards or flexibility in the market is adjusted pre-election in order for this not to be a big campaign issue. And
remember that 6% of loans written by the major banks are currently being written outside the current underwriting standards. In other words, the normal standards. That was reported by APRA recently. That 6% is higher than it's ever been. So the banks are actually breaking their own rules at the moment, even now.
There you go. Now, yes. So I mean, look, just to sum up the conversation, I think that the title of this episode is about the false Armageddon. So I think this is what we're seeing in terms of the press. I think they're obviously these are important issues, but I don't think that this is the main game in town. Now, obviously, in your model that you've presented in previous posts, and obviously you explained it to 60 Minutes, and this is where the coolest bet sort of came from, is you have a definition of Armageddon. I have written several articles for News Limited, but also for other organisations as well, saying that an economic Armageddon is coming. So just for the viewers, how about you sort of go through what your Armageddon is, and also how did you sort of come up with your definition of Armageddon? What was the underlying framework that you used?
Yeah, okay. So I basically ran a series of scenarios, and it was basically looking at the way that the housing market would behave, housing finance would behave, what the banking system would do in these different scenarios. And Armageddon was the worst case. It was triggered by some external factor, and I guess I used the analogy of what happened to Ireland. Mm-hmm. Right. So basically, that was a liquidity problem for the banks in Ireland, and it was an issue of poor mortgage underwriting. Right.
Yep.
And in fact, you can pretty much check off everything that happened in Ireland is happening here now, in terms of lack of good lending standards, mortgage fraud, and lack of liquidity. So my Armageddon scenario is we actually let that play out, and it's triggered by an external event. Probably corporate failure in the US because interest rates will go up in the US, creating a problem with corporate debt. Or possibly it could be something up in Asia. Who knows? But let's assume we've got that external event. But it freezes liquidity. That's the critical point, right?
Yeah.
As soon as the liquidity is frozen, the banks then have a problem because they have to try and continue to fund their book. They've got a lot of short-term funding, 90 days or certainly under a year, and that creates a problem for them immediately. At the same time, we've also got the situation where unemployment is rising because effectively the economic sort of downstream effects of all the stuff we've been talking about starts to impact. So effectively the economy goes into a reverse. We see interest rates perhaps taken a little lower, trying to deal with some of this, but not very effectively, right? And so you end up with rising unemployment. You end up with more people struggling to make those mortgage repayments, getting into difficulty, more defaults. In fact, the defaults start to snowball just at the time when liquidity is a problem for the banks. As a result of that, my scenario says that the Reserve Bank is then forced to intervene and provide liquidity to the banks initially. That won't be sufficient. They've then got to go further to try and find liquidity, and they won't be that successful, right?
Yeah.
And the net impact of that is that's going to have a very significant downward impact on home prices, so 40 to 45% over 3 years. We're going to see employment very much higher. We effectively see the economy go into this long, slow grind. And the analogy for me is Ireland.
Yeah.
So that's my Armageddon scenario.
Sure.
And I'm not sure whether you or I picked Armageddon. We'll have to go back and see when I first started talking about it. But the point is, it is meant to be a worst case view, right? And I gave it a 20% rating. So I'm not saying this is the most certain thing that's going to happen.
Yes.
But I could see it playing out, and if it did play out, this is what my models tell me could happen.
Sure. Okay, so that's your Armageddon. Okay, so let me go to my Armageddon.
Yes.
So I've been warning about this sort of scenario that I see as early as May of 2016 when I first published an article about household debt in the Daily Telegraph. But the term Armageddon we started using this when I started writing for News.com. And the first article was in February of 2017. Now, one of the things I was saying to News Limited earlier in the year was that there's a number of individual analysts around the world who are saying that when you've got the biggest debt bubble in the history of the world, and obviously in our country we've got the biggest debt bubble in our history, we're going to have an extreme economic event. And people have described that event to be something specific: a depression, a sovereign debt crisis, hyperinflation, etc. So what I said to News Limited was, I said, I've listened to all of these people, I've studied their scenarios, I've obviously got my own views, and everyone has, to be honest, a very logical case for why their scenario may play out. So I said, I don't want to be boxed in saying that it will be X. So like Steve Keen was very specific 10 years ago. it didn't happen exactly the way he thought, and then obviously he had to go run up Mount Kosciuszko because he lost the bet.
Yep.
So I basically said I wanted to present a range of scenarios, but I think one of these scenarios is going to play out. So this is anyone can Google this, and we'll put the link in the notes on YouTube. The 6 pathways to Australia's economic Armageddon. So this was something we published in June, and so basically the framework is based off typical Austrian economic sort of thinking, which is to say, from when you've got a bubble like this, you're either going to have inflation or deflation. So basically, I said, well, we're going to go in one of two paths. Either we raise rates and we do quantitative tightening, which particularly the United States has said that they're committed to. Now, when you do that, you're going to get one of 3 scenarios in my view, because as these interest rates go up, as you flood the market with more bonds, bond prices will go down. Yields on the interest rates will the yield on the bonds will go up, but also as the official interest rate goes up, the debt servicing costs of the debt will go up, and then at some point someone will default. So my scenario 1 was a recession/depression, a deflationary recession-depression, and basically what you would happen is a major corporation or a major or a major bank, financial institution, would basically say we're insolvent and we're going to default. And obviously this is like your Lehman Brothers, or there was an Austrian bank in Vienna in 1931 that caused the depression in Europe, or you look at what caused the depression in Australia in 1892 was Barings Bank in London, basically becoming insolvent in 1890. So these are the historical examples of when a big fish says we're done, that melts the markets down. So that's my scenario 1. So that is the private sector defaulting. Scenario 2 is when the government defaults, and this is your sovereign debt crisis. So this is obviously the Greece example. Yep. Now, obviously, I don't think Australia is at risk of a sovereign debt crisis, but obviously, if Italy or if France or if Japan were to default, that would have massive implications around the world, and that would likely tip the global economy over, and we would probably go right through it. So a recession/depression, I think, is a very likely scenario because of how indebted we are, but also because of how indebted the world is. Sovereign debt crisis, I don't think we will personally go through one, but the risk of a sovereign debt crisis in some part of the world leading to systemic implications for the global economy, I think, are quite high, and so would be swept right through that. So scenario 3 is a local currency crisis, is where a foreign country will default on its foreign debt. And obviously the classic example where we're seeing that at the moment is Turkey. So we've seen, early in the year, I think in July, August, the Turkish lira fell 32% in 3 weeks because there was concerns about Turkey not being able to meet its foreign debt obligations. So obviously when a country defaults on its foreign debt, the counterparty has to take the loss. If the counterparty can't take the loss, then you get contagion and it starts to spread. So that's what the 3 scenarios I think we're going to see if we have deflation, if the rates go up and you get someone defaulting. The counter flip is that they don't want it to, they don't want the bubble to pop, and they try to keep the bubble going. Or if the bubble does pop, they try to put the bubble back together. And so to do that, this is where you're going to go to zero interest rates again. You're going to have quantitative easing. And, Ray Dalio put out a publication in the last week or so talking about, the 10 steps towards a significant crisis. And in an interview with CNBC, he basically said, the next time around, we need a third tool. He said, we've got interest rates, we've got quantitative easing, but to keep the show on the road, we need a third tool. Now, what is that third tool? Is it the cashless society? Is it negative interest rates? Is it universal basic income? Is it helicopter money? He didn't say what that tool was, but he says in order to keep the show on the road, we need a third tool. Now, what is that tool? Don't know, but whatever that tool is, it's likely to mean we're just going to be printing more money or pushing more debt into the system. Now, when you do that historically, you get inflation in the sense of you're increasing the money supply. And obviously, once you do that, you lose the purchasing power of the currency. Obviously, this was what we talked about in episode 3.
Yep.
And obviously, you then get a loss of confidence in the monetary system. So scenario 4 in my model was that we would have runaway inflation or hyperinflation, and you know, whether that's of a global level or a local level, possible. Scenario 5 would be at stagflation, which is what happened in the late 70s, where you basically have slow growth or falling growth, rising unemployment and rising inflation. And obviously when that happened in the 70s, in order for the US to combat that, they had to raise interest rates to 22% under Volcker, and then you had like a massive recession in the early 80s. Because they had to deal in terms of the inflation that came out of the stagflation, or you have a global currency crisis, and so people like Jim Rickers have actually talked about this. So you know, we haven't talked about gold, but at some point we will. But you know, you look at what China is doing. China has been amassing massive amounts of gold over the last decade. So have the Russians, so have the Iranians, so have the Turks, other countries in Europe. And obviously now you're getting voices, particularly the German finance minister in the last 2 weeks, saying that the world needs a new system other than the dollar system. So since 1944, the global monetary system has been based on the US dollar. And between 44 and 71, it was the US dollar backed by gold. And then in 1971, Nixon closed the gold window because they were running out of gold because they were spending enormous amounts of money in terms of Vietnam. And when they closed the gold window, they needed something else to restore confidence and use of the American dollar. This is where they came up with the petrodollar system by basically saying if you're going to buy oil, you must buy the oil in US dollars. So this has allowed the Americans to blow up their money supply over 40 years. And now people are thinking, well, why am I going to sell real goods or services to America and just get pieces of physical or digital paper in US dollars? So you're seeing this emergence of a loss of confidence in the current monetary system, in the American dollar, and in the American system. And now certain countries are voicing public opinion that they want a different monetary standard. Now, if there was tomorrow, the IMF or the Chinese or the Russians saying that rather than the Australian dollar, on an exchange rate basis, rather than the Australian dollar being worth X US dollars, it was being, if you had a complete reevaluation, that would have enormous implications for the Australian economy about what our money would be worth on the international market, and we would see rapid changes in terms of the exchange rate, and that would have enormous repercussions for the middle class, particularly if the Australian dollar lost a lot of value in that process. So that's what a global currency crisis is. But I think I'm confident that one of those 6 things is going to happen, because when you've got a bubble this big, I don't see how that there isn't going to be some sort of systemic crisis. So I think you've said Armageddon is 20% chance. Well, I think one of my 6 Armageddon scenarios will definitely happen, probably in the next 3 to 5 years. Now, I think some of these things will come ahead before the 3 to 5 year period, but I think one of these 6 things are going to happen, and it's just a question of, well, which one of these is going to play out.
Okay, so basically we've got a mini Armageddon, and then we've got a bigger Armageddon over the hill, as it were.
Yes.
Right?
Yeah.
And it seems to me that because of the fact that you've got lots of different potential triggers,
yes,
all of which lead you to a problem.
Yes.
But the journey to that problem could be inflation or it could be deflation, right?
Yep.
You've actually got an even more significant set of risks, because if you pull one set of levers here and it's actually the problem over here that's creating it, you pull the levers the wrong way.
Yes.
Yeah?
Yep.
So that makes it very difficult to manage.
So it's difficult to manage, and from my perspective, I think policymakers, I think parliamentarians are looking at the false Armageddon, saying, well, we know this is a problem, and the Australian Bankers Association knows that interest-only loans is a problem. But in terms of the real Armageddon that I've been talking about, I think there are pockets of people who understand what I'm talking about and actually agree that we're going to have a more systemic crisis than what the ABC or News.com are talking about in terms of today's press. But obviously we had an economist, Martin Fieldstein, who's the president of the US National Bureau of Economic Research, who came out in the last week and basically said that that the Armageddon I'm talking about, he called about in terms of the next recession. There is no strategy on how to deal with it, and it could rival in terms of the Great Depression. So he basically says the debt is so big, when this blows up, policymakers around the world have no strategy. And obviously, from the interactions I've had in Australia, and particularly in federal parliament, there is not only there's no strategy, I think there's no understanding or recognition that we have such a large systemic problem in terms of this country, but also in terms around the world. So when you're getting it now, the voice is getting louder. You've got a prominent US economist saying where an extreme economic event is coming, and that there is no strategy by top policymakers around the world on how to deal with it.
So effectively, we could say then that Morrison, going back to his quote earlier on, he's sort of taken a first step into the foothills of Armageddon, and he's touching a little bit on the house price thing and talking about, well, we've allowed it to settle it, no problem, right? But beyond that, there's this whole new landscape, right, which is the real Armageddon.
Yeah.
And nobody is really seriously thinking about the implications and consequences of the stuff that you talk about.
No.
That's a big problem, isn't it?
It is a very big problem, and obviously, as we've discussed in previous episodes, I don't think you're going to get any serious contemplation or thinking or action by our Prime Minister between now and the election in terms of dealing with the big bubble challenge that we have beyond what he's described today in terms of the soft lending and house prices.
John, I really appreciate your time today. That's been very interesting. And I guess that we will see how the Armageddon scenarios play out in the months ahead. But it sounds to me as though it's going to be a bumpy ride.
Absolutely.
Thank you very much for your time.
No problems.
So you can pick your own Armageddon. You can have a small one. You can have a large one. You can have lots of different flavours. But I think the net of all this is that things are looking relatively uncertain in the months ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching. Check back next time for the next instalment.